So the assumption you had that he was going to keep things contained goes out the window, in which case you gave up on the Democrats. They're fractured as a party. And suddenly the Republican Party which is getting more and more fractured, by the way. Anyway, the old conservatives in the party have long since abandoned Trump. And if Trump suddenly looks like he's failed, especially in regard to keeping cost of living down, then that's an upset factor. And so when people are upset, their wife got laid off, you got laid off, your credit card's at the limit, you're past due, you can't pay your taxes this year, so you figure out I'm just not going to file, or I'm going to ask for an extension. All these things come together and creates emotion. And I think that is on the cusp right now, especially if the stock market does what we think, which is to say, ooze back below that old high and upset the notion that, oh, we were going up forever. Now we're not. Okay. So, and in other words, emotion could come into play, I think, in the next 6 months.
Yeah, it does seem to be a trajectory. And what do you think for the bond market? Because I guess, as you said, historically, it's been a safe haven. It's sort of yields would decrease when you're going through this recession, but it hasn't seemed to have that correlation. Do you think
it has not worked out as an alternative this time? When the stock market broke from January through April, the bond market, gold was going up. It surged from early year to April while the stock market was going down. So money was moving into gold, but it wasn't moving into T-bonds. Now, right now, we've got a little rally going, a couple of points in T-bonds for the last couple of days. But when you look at a long-term, even just a price chart of 30-year T-bond futures, or look at a yield chart, long-term rates, don't look at the short-term, it's clustered. You're really just stuck in ink sideways, but at very low levels on price, very high yield levels, in which case it almost doesn't matter whether rates go higher. It's just hanging around here is like a noose on many corporations, which have, as I understand, a lot of commercial real estate has debts coming due this year and next. So, they're not getting any relief, just if rates stay where they are. Now, the question is right now, is this T-bond rally we're getting over the last 2 days finally going to join gold as an alternative? I have my doubts. I'm not going to say it can't, but it hasn't so far. And frankly, we've got numbers below the market, which it has not yet triggered. I'm talking T-bonds now, T-bond prices, that if they get to you're going to have a mini panic in the bond market as well, to the downside in price, upside spike in yields. That hasn't happened yet. And the question is whether the government can keep it from happening, because we know they have a major debt problem. And it's, I don't, like Jamie Dimon has said, I don't think this time they're going to avoid it. So anyway, we'll see. But as far as an asset to buy to protect yourself against a losing stock market, so far it has not done what it normally does.